Hi, guys. Welcome to What Are We Building Today? This is the weekly podcast where we talk about what our clients are actually building and what professional real estate investors and even average homeowners are focusing on. And we at aduloans.net and Cross Country Mortgage, we lend to these. So we see the detailed return on investment, what the monthly payments are, and why certain approaches are just so popular. So, with that today, I'm going to start with something called the rise of the DSCR loan. We haven't seen this loan really since before the housing crash, because during the housing crash, pretty much everything fell apart, and banks and particularly the govies took over the overwhelming amount of lending and pushed out the private market with options like DSCR, even bank statement income, that kind of stuff. But now that the GSEs, the government agencies, are kind of pulling back and they're saying, you know what, we really don't want to finance investment properties, the private market has come back in with some of these great loans. And before you say, well, wait a minute, didn't this cause a housing crash? No. Let me explain how DSCR works, and you'll see what I'm talking about. DSCR loans stand for Debt Service Coverage Ratio. And what it means is how much does the rent cover the cost of the monthly mortgage payment, principal and interest, as well as property taxes and insurance. And if there's a homeowner association, you would include that too. So if the rent covers 100% of the total housing payment, you would have a DSCR ratio of 1. If the rent covers 125%, meaning you're cash flowing a bit, then that is a DSCR ratio of 1.25. Now, let's say the rent doesn't cover 100% of the mortgage. Maybe you're short. Maybe it's only covering 75% of the mortgage. Believe it or not, we can do those loans as well. And that means that is a 0.75 ratio. And we usually use those, as I'll show you in a second, as a very temporary loan for a variety of reasons, namely as a holding place until you can convert the property into a cash flowing property. Now, with any risk measures, most of these are with 20% down. But if you're cash flowing considerably, like 125 or 150%, sometimes you only have to put down 10, 15%. So the terms are very risk based on whether these properties cash flow or not. And the less they cash flow, the stricter they are. For example, the more down payments required, more cash reserves you have to show, all kinds of things to qualify. Now, DSCRs are important loans, therefore, are for investment properties only. They cannot be used on a primary home or even a second home. We have to show that it is being rented and that the rental income is covering that total housing payment. Um, but the great part is that we're not looking at with these examples, we're not looking at your personal tax returns, monthly income, etc. So the paperwork is a lot less. What you do have to prove is that you have cash reserves and a down payment to buy the property, or or if you own it already, that you've got the appropriate rental income and the cash reserves just in case somebody quits and you got to go find another renter. So let me show you how DSCR works, because the same rules also apply to commercial bridge loans, sometimes called hard money or private money, to renovate or build properties. This is an example of a client who is purchasing a property, and it's a duplex. It is a complete and total teardown. He is purchasing it at 650,000 per month. The current estimated rent is only 3,500 a month. So when we adjust this, he can get a rate on a what's called a low rent or low 0.75. In this case, we did a no ratio loan just in case. The appraiser did give it some rental value, but it's in pretty poor shape. So we were concerned about that. But anyway, so as you can see here, the DSCR ratio right now is at 0.83%. That means this rent only covers 83% of the total monthly mortgage payment. That's the actual mortgage payment, property taxes, and insurance. There is no homeowners association. So his net cash flow is negative by 737 $735.97. Now, why would anybody want to buy a non-cash flowing property? And the answer is because he's going to tear those down. He needs to purchase it to sort of hold it in place. And then he's going to do a construction bridge loan. And a construction bridge loan, he is actually uh, building $400,000, rebuilding those two duplex units, tearing them down, rebuilding it, and he's actually building two additional more. And these are the estimated rents. And if he decided to sell them off, these would be the estimated sales prices. So he's cash flowing either way, but he wants to hold and rent this. So a construction bridge loan is we would then, when he's ready and he's got the permits done, we're going to refinance into a construction bridge loan. And this, you'll notice, is based on future appraised value. Now, we're only using the estimated purchase price plus the cost of construction, but to be honest, it's probably future value is going to be about 1.2 or 1.3. We're just trying to be conservative. Now, you'll notice this loan amount is higher than the first mortgage. And that's because we're adding this $400,000 construction budget into the mortgage and financing 100% of that construction cost in this case. That's always the goal. If you don't have to be out of pocket, we don't want you to be. Now, the rate is stupid high, absolutely. But what's really great is it's a line of credit. So if you only the first month, if you are paying only the mortgage payment on the first mortgage, your monthly payment drops and it's definitely higher, but as you add to the loan, buying materials, paying for labor as you build, your monthly payment is going to go up and up and up. But what they're looking at is would the rental cover, a portion or basically in the future when you're done, will this pencil out? And even if rates never came down, it would still cash flow $604 per month and change. Now, we're not going to keep a rate of 10.5%. This is a temporary loan, and it's really only for the 6 to 8 months of construction. And the second you're done with that, you'll notice we've got month 1, month 7, and then as soon as you're done with construction, we're going to refinance that to a classic 30-year fixed. But again, we're using a DSCR loan. We're not looking at his personal income taxes, and that means he can write off everything on his property taxes. He's a real estate investor. That's very common. We expect a property like this, as interest rates normalize, to be at about 6%. We have the total budget, which included the original purchase mortgage plus the construction cost. And based on that, now your monthly rental income really is $9,500 a month. We get the rental agreements, etc., and he'll be cash flowing $3,401 per month. Per month. So even though this first loan does not make sense, because why would you lose money on a property in and of its own, this pro forma shows you how DSCR loans work across the board as a team. This is the kind of pro forma you want to do for entire projects, not just the, hey, let's get it done and hope that it all works out, but what is your exit strategy? And that could be renting them out, or it could be selling them off. And we did look at the rent versus sell options on this. I'm not going to share. What's most important is understanding how DSCR loans work and why they're so important to investment properties, but also why pro formas are so important. A pro forma is just an Excel spreadsheet that helps you estimate your rents, your management costs, all the other things. This is a very simple one, and you can get many more, frankly, on any AI chat or off the internet. And they're interesting to compare because many of them dig much further detail than mine does. And that's great. These are the types of, as you grow into your real estate investment properties, you want to use these pro formas regularly. Why? Because a pro forma like this, I as a lender actually use. And then we also want a spreadsheet showing your schedule of real estate, i.e., which properties do you own? What's the mortgage balance? What's the current value? What's the expenses? What's the rental income? Because if in this particular client, I am sending the pro forma and the schedule of real estate, which shows his experience that he's running profitable rental units, we're going to send that into the underwriters for approval on loans like these. This helps explain to underwriters who may be a perfect stranger to you. An underwriter is like the judge of the bank. Oh, this guy has experience, he knows what he's doing, and he's planned a whole plan, including the exit strategy, to work through this loan and make this property profitable. So that's today's explanation on DSCR loans and the importance of pro formas. Here's the cool part. Math doesn't lie. So when in doubt, if you're not sure about a project or you lack the confidence to move forward, run the math. That will tell you if it's worth it. Thanks so much for joining us today, and we'll be back with more builders and other updated news next week.